welcome to the formula video. And so we're going to discuss the formulas that you need to know for test 2. So I hope by now that you are very familiar with your marginal costing format. This is 100% going to come out, and you definitely need to know how to work it out. It's your sales less your variable cost. Sales minus variable cost gives us our contribution margin, and our contribution minus our fixed cost gives us our net profit. Then we have our margin of safety as a value to calculate our rands, which is your total sales minus your break-even sales, and your profit divided by your contribution margin ratio. We have our margin of safety in units, which is your margin, which is your total sales in units minus your break-even sales in units. Okay. Then we have our margin of safety ratio. Wherever there's a ratio, it's a percentage. Wherever there's a percentage, it's a ratio. Okay, always remember to include your percentage sign at the end of your answer, there's two ways to work it out. Your total sales minus your break-even sales divided by your total sales value. Your total sales value is equal to your total sales. It's the same thing. They just decided to confuse you. And your total sales in units is equal to your total and your total sales in units minus your break-even sales in units divided by your total sales in units times 100. Okay, just before we go on, I just want to show you this is very important. Your break-even point in rands is equal to your break-even value, which is equal to your break-even sales, and your break-even point in units is equal to your break-even quantity. So these formulas can be used interchangeably depending on the context of the question that you are given. So then you have your break-even quantity, which is your fixed cost divided by your contribution margin per unit, or your break-even quantity, which is your break-even value divided by your selling price. You have your break-even value, which is your break-even quantity times your selling price, or your fixed cost divided by your contribution margin ratio. To calculate your sales volume in units, it's your fixed cost plus your target profit divided by your contribution margin per unit. Then we have our sales value, which is your sales volume times your selling price per unit, or your fixed cost plus your target profit divided by your contribution margin ratio. Then we have our number of units to achieve our target profit. So we have one for units and you have one for your rands. For your units, it's your fixed cost plus your target profit divided by your contribution margin per unit. And for rands, it's your fixed cost plus your target profit divided by your contribution margin ratio. Right? Then you have your break-even point in units, your break-even point in rands, and your contribution margin ratio, which is very simple. Okay. So for section 2, this is your present and future value tables. Your table A, alright. So for table A and table A is equal goes with table C. Table A and table C represent uneven values, and table B and table D is when you have even values. Okay. So in a test, if you're given like 135,000, that's uneven values. You'll either use table A or table C. But since we didn't do many with table C and D, I would say then you just use table A. But if you have the same amount, then it's going to be table B. Okay. Another point is when you're doing your calculation for your present value, when you're working with an even value, you don't add up. You're not going to add up the cash flows for each year. You just take one cash flow and you multiply that by the discount that it's asked for the number of years. It's only one calculation. Okay. To do our buyback period, when you have even cash flows, it's your initial investment divided by your annual net cash inflow. And when it's uneven, you will just simply add up your given cash inflows until you reach your initial investment. All right, then we have our accounting rate of return, as you can see. All right, if you have depreciation, all right, then then you must have your total cash flow minus depreciation. When it comes to your average profit, you must calculate that first before using your net profit. Okay, for your average profits, it's your net profit, which is basically this answer here, your total cash inflows divided by the number of years. All right, then for your average investment, it's going to be initial investment plus your residual value if it's given, divided by 2. If it's not given, it's just initial investment divided by 2. Then you have your internal rate of return, which is followed by this formula. The key here is also that the values that you are not given, if they just, let's say they just give you value A and value C, and they ask you to calculate your IRR, you can pick whatever values you want to, but the catch is your value for B and your value for D must always be higher. It has to be larger than value A and value C. Okay, value B and value D must be higher than value A and value C. All right, and remember, if D is a negative value, then we're going to add C and D in the end here. So you'll go C divided by C plus D. But if this value is positive, then we just C minus D divided by C. Okay. And lastly, when it deals with depreciation, if it says depreciation to 0, it's your initial investment divided by the number of years. But if it says straight line depreciation, then it's your total cash flow minus your initial investment. I also just want to give you a last piece of advice, and that is to practice exercise 6 from chapter 18 to go over how to calculate your operating cash flows. Okay, remember in test 1 I gave you the cash budget question, and in the test cash budget question we did was almost identical. Okay, and now I'm telling you, practice exercise 6. Okay guys, good luck for the test, and I hope it goes well. Cheers.